Well, it grabbed headlines this morning in the Financial Times. Traders and investors are increasing purchases of insurance against a U.S. sovereign debt default. My next guest says credit default swaps trading is all about the debt ceiling debate. Joining me on the phone from Stamford, Connecticut is David Ader, the head of government bond strategy at CRT Trading Group. David, welcome to Bottom Line. Thanks for coming on.
Thank you.
David, how concerned should investors be that come August, the U.S. could in fact miss a payment on its debt, in effect a U.S. sovereign default?
I would put that fear, that worry, at a very, very minimal level. You know, the issue here is a political one, obviously. It is possible, although I don't think it's going to happen, that we may postpone, not cancel, not stop the debt payment. It's possible, but I think they'll take it to the final hour, and then everything will be sorted out. It's not a case. We are not Portugal. We are not Greece. We have the money. We will pay it. This is a political issue, and I think the investors know it.
Well, David, if I might ask then, does the increased activity in derivatives mean some traders are already pricing in a U.S. debt default?
I think it's probably not so much that they're pricing in a default. I mean, we're only talking about, U.S. credit default swaps at 50 basis points, so it's relatively cheap insurance to buy. Rather, I think that there's probably some people who have had a particular trade on, and I do want to emphasize that it's a trade. It's not a trend. It's not been a dramatic increase in volume. We think it's really sort of a one-off that happened over the course of a day that we saw an expansion of it. And I think it's a hedge against, another obligation that's going on there. But no, I would not say it's a wholesale. I would not say that it's a wholesale flow or trend that people are buying this protection.
David, why does it appear that the cash bond market isn't being affected by what's going on in Washington concerning the debt ceiling? And we should point out yesterday the 10-year Treasury closed at 306. It hasn't been that low since December.
That's right. Well, I think the first thing is because the bond market as a whole doesn't believe that there's going to be a debt ceiling crisis, that is going to be even a brief postponement of any cancellation of a coupon payment, for example.
Right.
What we're focused in on is the same, but rather for Greece, potentially the other pig. So that's certainly been a strong influence to us and in Europe.
Right.
And as well, over the last week, 2 weeks, 3 weeks, we've seen this, rather sharp shift in the data to a much slower trajectory.
David, if I might ask in our last minute, as you well know, QE2, that's going to stop on June 30th. Give us a few scenarios on how the bond market's going to handle that.
We've been worried about the end of QE2 because once the Fed stops buying basically the equivalent of all the new issuance in the Treasury market, suddenly the buyer disappears and interest rates were going to go up. But we all know this. This has been, sort of priced in and anticipated. And I think now the shift is, to the extent that QE2 has benefited risk assets, credit, for example, corporate bonds, mortgages, and it has, and the Fed's acknowledged that QE2 helped the stock market. Well, now we think that come the end of June, it becomes a risk-off trade, and the treasuries that they've bought have provided liquidity to buy all those other things. Now you got to buy treasuries, and the liquidity in those other areas comes off. So we think it could cause more of an underperformance in risk assets to the benefit, possibly, of treasuries.
David Ader, head of government bond strategy at CRT Trading Group, joining us on the phone from Stamford, Connecticut. David, thanks. Enjoy your weekend.
Thank you.